How's it going, YouTube? This is Jourdan Wright, and before I get into the video topic of 8 biggest mistakes in investing, I'm first going to explain why it's important to invest. Just simply, it's getting more expensive for the average American. From 2001 to 2010, after adjusting for inflation, wages have decreased 2% for the average American. And during that same time period, rents have also increased 6%. So if you're just relying on your primary source of income, it's going to get more expensive to pay bills and make ends meet. And another good example is with this coronavirus. Millions of Americans are starting to get furloughed, wage cuts, or even laid off. And if this is your only source of income, then you're not going to be able to pay your bills. You're not going to be able to keep a roof over your head. You're not going to be able to survive. So investing can provide you with an additional source of income. And it can also help you build wealth, not only for you, but for the generations, your children, your grandchildren. It can be passed down. So for these 8 biggest mistakes in investing, some of these mistakes are ones that I have made. Some of these are mistakes that I've seen others make, and some are mistakes that I've heard others make. And these mistakes can really take a toll on your investment and even make you lose money if you're not prepared for them. So for number 8 of the biggest mistakes in investing, it is not creating goals beforehand. So whether you're planning on creating another source of income, or you're planning for retirement, or you want to build wealth that can be passed down, is going to have an impact on which assets you invest in. So if you're building an income, you might want to look at real estate because you have that monthly cash flow. Or stocks, even though they're struggling right now, stocks can be a good way to build wealth over the long term. So if you don't put goals you're investing for, you might invest into the wrong asset that's for you. So for number 7, it's not accounting for fees. Whether you're investing in real estate, stocks, foreign exchange, everything's going to have fees. In real estate, it will be closing costs and transaction fees, as well as the interest you're paying the bank to borrow money for that house. For stocks, a lot of brokers will charge you either a flat fee. So for example, for every transaction, they may charge you, $5 or $10, or they'll charge you based on the percentage of the trade. So if you're trading, 10 shares, they may charge you 5 cents a share, or the amount of money that you're trading. If you're trading $10,000, they might charge you 0.1% of that trade. So depending on if you're frequently trading, if you're trading high amounts as compared to small amounts, you might want to compare the differences of what types of fees there are. So number 6 is not tracking performance. How do you know if your investment has been paying off? Or how do you know you're on track to meet your goals? If you're not continuously tracking your performance, how do you know if your investment is actually worth the time and the effort that you're putting into it, as well as the money? Number 5 is excessive turnover. And what that means is you frequently trade in and out of positions. And the problem with that is that it increases the amount of fees that you're paying. Whether you keep on buying and selling houses, or you keep on buying and selling stock, those fees are going to eat into your return. 4 is letting emotions guide your decisions. So if it's fear that, the market has dropped 10% or 20%, you're scared of losing more money, so you take your money out, even though you're not retiring for another 40 or 50 years, or you sell the house because you don't want to put in the work. Or it can be remodeling and putting in the top finishes of the house to make it gorgeous, but you're not going to get that return when you rent it out. So you want to make sure that you keep your goal clear. You want to get a return on your investment. It shouldn't matter if you love or hate the company, or love or hate the property. You want to make sure that you're getting your return, that you're meeting your goal. Number 3 is not knowing how fees impact growth. And it's similar to not knowing what the fees are, but there is a huge difference. Something as simple as a 3.5 compared to a 4% interest rate on the house, you might think, oh, it's just $100 extra. But in reality, over the life of the loan, it can be thousands of dollars. Another example is a mutual fund that I opened when I was 15. So mutual funds, they're professionally managed, they're going to charge a fee with any account. So I remember seeing the 1% fee and I was like, 1% is not too bad, I'll be fine. And now looking back, I've seen that 1% has really eaten away at my returns. Number 2 is not knowing the difference between market price and value. So basically, market price is what someone would pay or what you would have to pay to get that investment, while value is what it's worth. So in real estate, an example would be the cost replacement value for a house. Let's say the market price for a house that you're looking at is $400,000, and you can ask a builder how much would it cost to buy that land and build that house from scratch. And if the value might be $350,000, or it could be $450,000 to $500,000. So market price is just what someone is willing to pay right now, while value is what it's worth. Or a lot of time you hear that investment is overvalued or undervalued, and it's different from market price. So it's important to understand the difference, because you can find some really good deals or you can overpay for an investment. And number 1 is not understanding the investment. Well, this might sound like common sense. Why would you invest in something you don't understand? And that happens plenty of times. In real estate, if you don't understand the market, you understand what buyers are looking for or what renters are looking for, or what increases the value. You know, a pool might increase the value exponentially in some areas. And here's another way to look at it. By not understanding what you're investing in, you increase unnecessary risk. And B, risk that does not increase the potential of a return. The number 1 cause of unnecessary risk is not understanding the investment. So I hope you guys enjoyed this video. I hope you learned. And if you're looking for more content, or if you're looking for more tips on how to invest, be sure to like and subscribe down below.